I have a saying that when times are pretty good, I start off my morning by going to NewYorkTimes.com, and maybe something there will make me happy. When times are somewhat volatile, I start off my morning by going to FT.com, which is more on the financial side on average. When I'm really worried, I start off my morning by going to Bloomberg. There'll be all the prices scrolled across the top of the page, and the point is I've been following particular prices for days, and that has a lot of meaning for me. So lately I've been spending a lot of time in the morning going first to Bloomberg, and I'd like to explain to you all why that is. So not that long ago, my view was that the chances of a soft landing actually were going up. I was modestly optimistic, but now I'm much more pessimistic. And I think what we're seeing is a number of different revaluations coming together. And I'm not sure how bad they will be, but these are the main revaluations we're seeing. And I'll go through each one. But let me just say, interest rates, perhaps in real terms, need to be higher than we had thought. The cost of energy seems like it will be very much higher for longer than we had thought. So I remember early in the Russia-Ukraine war, when a lot of people believed, well, they'll attack Ukraine, they'll take off some eastern parts of the country, then there'll be a settlement, and then the gas will flow again. Clearly, that's impossible now, but no one has thought that for a while. Number three, the Ukraine war itself will be worse than we had thought. And I don't mean for Ukraine here or for Russian soldiers. I mean for the macro economy. The China downturn arguably is looking worse than we had thought. And this notion of a very strong dollar and a lot of currency volatility all of a sudden is looking worse than we had thought. Now, these five are interrelated, but they're also distinct. So I'm made very nervous by the fact that we're in a situation where all five revaluations seem to be going on at once. So I don't think I know how bad this is. I don't think the market knows. I think that's why market prices are volatile. Markets are trying to figure out. I'm trying to figure it out looking at Bloomberg each morning. But for each of these, there are different ways you can read the data. So if there's a strong dollar, as obviously there is, you could plausibly say, as people have been saying, well, the U.S. economy recovered first from the pandemic. It recovered more strongly. We did more stimulus than many other countries did. And maybe we have some natural advantages due to being a large country. That seemed plausible at the time. Surely those are factors. But I think now there's increasingly a worry that the strong dollar, which is getting a lot stronger, so that old story is indeed an old story, has truth to it. But the dollar has been getting much stronger lately. That may be a kind of safe haven international risk premium because people are worried about some mix of the factors on this list. So again, all of the points I'm going to make, there's a more optimistic and a less optimistic interpretation. You can see this in my slides. So often when I give talks, I have slides that are prepared in advance. I have an assistant improve them, put in colors, put in graphics. These slides I made this morning, that's not the right way to do it. But actually, had I done it a week ago, it would have been quite off and not actually appropriate. So these are like minimalistic slides that I just came up with. So rise of the dollar, this picture, I think it's like 2 days out of date, but it's really quite striking. I mean, the US dollar is going up. Virtually all other currencies are falling against the dollar quite a bit. Japanese yen, the most. And we've seen around the globe a series of interventions. The one that got the most publicity was from the United Kingdom, but Bank of Korea actually decided to do some version of the same. Japanese are very worried. So again, there's a number of ways to interpret this data, but one is strictly the direct causal effect that emerging economies with dollar-denominated debt, for instance, their corporate liabilities, they will face much higher burdens typically because the dollar is much stronger. I think there were some days where the rupee went up against the dollar, if you're wondering, like, are there exceptions? But still, this is really a very striking picture. And there's the direct causal effect on dollar-denominated debts elsewhere. But I think also, since this is quite recent, these big price moves, you have to wonder if it isn't more than just the older story of the American economy recovered from the pandemic more quickly. So this I watch every day. Just as an aside, if you have the luxury or liberty of traveling as an American earning US dollars, there's hardly been a better time. We're mostly taking pay cuts in real terms, pay boosts in nominal terms, but when you're spending abroad in real terms, your purchasing power is much higher. So if you're going to go somewhere, now's the time. I was just in South Korea. Paul was there too, just in Canada. And so intertemporal substitution, that's a micro idea. The British pound, this got a lot of attention on Twitter. I don't think it's so much of a story. I think the Truss government instituted some policies. I would call them bad investment. And in terms of PR and communications, I would call them very bad timing. I think there are good reasons one could object to features of these policies. I very much like the deregulation, the greater freedom to build. But on the fiscal side, they thought they were going to get some kind of gain in the growth rate that I believe is just not there. But there were a lot of proclamations of doom from economists I often agree with quite a bit. One would be Summers, another would be Furman. Paul was briefly a part of this debate. My view is much closer to his, but Summers and Furman said, well, this is like one of the worst macro policies ever. I think it was, you could call it a bad micro policy. So briefly, the pound fell from 1.09 to 1.03. You see something like that in this graph. And now, as of last night, haven't checked during Justin's talk, but last I saw the pound was back to where it was. But longer term, over a 3-month horizon, over, 2-year horizon, British pound is falling. And it's doing something a lot like the other currencies. In my opinion, their main problem is a human capital problem. And I don't yet see that they're doing anything to fix it. So I will be in London in November, and I'm watching this price. But again, that is a broader international issue. Yields and real interest rates. I think it's very hard to tell right now what expected real interest rates are. So obviously we can see nominal yields, we can see nominal interest rates, but there's the broader question of what will the rate of price inflation be, and what do market participants expect the rate of price inflation to be? If you look at 5-year break-evens, they paint a fairly optimistic picture that rates of price inflation will fall pretty steadily and actually pretty quickly. Not everyone believes that story, but here's what I think the broader issue is. So during the years of ZIRP, zero interest rate policy, you have something close to or at zero nominal rates, but there's some positive price inflation. Say it'd be 1.8, 1.9%. So the real rates would be close to negative 2%. And there's the general question, I'm not even sure if this is a micro or macro question, but is it a longer term equilibrium to have a real rate of return on your government bonds of negative 2%? This is, as you all know, a significant literature on this, the equity premium literature. What is an allowable difference between the expected rate of return on equity and the expected real rate of return on government bonds? I don't think those issues have been solved, but the notion that negative 2% real can last forever, I've just long been suspicious of. I see that it can last for a while, especially when there's precautionary demand to hold, say, treasuries, global precautionary demand, lack of other safe havens, collateral demand to hold treasuries. But just in terms of that medium, longer run equilibrium, can you have those rates of return at negative 2 forever? Well, certainly for a while people thought you could. Tech companies were valued basically along the lines of zero interest rate policy by venture capitalists. That stopped happening. So tech companies, in this story, they were the first to fall because their valuations were so sensitive to the discount rate you would apply. Crypto fell very early on. It was never an inflation hedge. You can think of it as a long-term project that may or may not work, but it's a long-term project. And as the real interest rate rises, you expect crypto prices to be hammered. And indeed they were. So you can think of crypto and tech as a kind of canaries in the coal mine, the most obviously discount rate dependent ventures. And maybe what we're seeing is just different parts of the world waking up at different speeds like realizing, well, to actually have a sustainable equilibrium, it's not just that real rates on government bonds, they can't be as low as negative 2%, but they're going to have to be really a fair amount higher. So we wake up this week, at times, mortgage rates in this country were averaging 7%. I think they're a bit below that again. Yields were at times, at 4%. They're a little below that again, but close to 4%. And we just have to ask ourselves how much needs to be revalued as real interest rates going up. And the world, and I think the UK in particular, but all parts of the world, all financial markets are facing this major question. Just what is the new equilibrium? Is some form of what Summers has called secular stagnation coming back? Are we going back to some world of the 70s, not as terrible as the 70s, but nonetheless with the normal variables and a lot of supply side constraints? But here you just see some data on yields. This is US Treasuries. Two noticeable things. Like one, they're going up a lot very quickly. Two, compared to earlier times, they're not extraordinarily high. But again, it's this question of what's the revaluations or reshufflings that are needed compared to expectations. And it seems we had a time period where people were making plans as if these very low rates would last forever. And that's just another concern I have feeding into this bigger picture. Energy price shocks. Even if you've never traveled, take a guess. Which country is this? It's Germany. So there's a report. It's still private and internal. I do believe it will be released. But it's from a major investment bank. I'm not saying this source has always been correct, but it's a highly credible, highly establishment source. And they are estimating that the hit to German GDP will be 10%, mostly due to higher energy prices with knock-on effects. 10%. I don't know if that's the correct number, but I think we all know that situation is very bad. One thing I'm pleased about, my text with Alex, from the first edition onwards, we have had significant coverage of real business cycles from the supply side, which are often neglected in macro. Now, our current turmoil has a number of different sources, but they are right now mostly real factors. Certainly for Germany and much of Europe, they are mostly real factors. And I like to say, if you look at all of world history, over 99% of all business cycles have been real business cycles. It's not true lately, wasn't true in much of the 20th century, but it's true more generally, and it's true today. I will get to pandemics. But just right now, energy price shocks are a big deal. And just working through what happens when the price of oil goes up quickly and radically and in an unexpected manner. That is the world we're living in. So those prices are in better shape than they had been. But when you look at particular places and what they are actually capable of doing for supply, Germany is racing very quickly to put in new liquefied natural gas terminals. They're, shortcutting in the permits process and so on. But still, if they're taking a very large hit to GDP, as seems likely, I don't even know if recession is the right word for that, but a major development, and again, quite an unwelcome one from anyone's point of view. Another point I would make, this one people tend to give me hell for, but I strongly believe it's true. I don't think COVID is over. Now, I'm not saying we ought to lock down or close schools or that everyone has to come here wearing a mask. I'm not wearing a mask and so on. But if you just look at the issue that 500 Americans are still dying a day, it is the case that probably there are new strains evolving, now measured at 12% in this country. It's a highly imperfect measurement, but at 12%, you have to wonder if it won't continue to grow. There seems, at least in the laboratory, to be a fairly high degree of immune escape. I don't think the new strain would push us much above 500 people dying a day. So in that sense, macro is not a huge deal. But just for long-term planning, medium-term planning, business conferences, setting up offices, I know travel now is not down. It's quite robust. But what kinds of trips people end up taking, and whether they're like higher return, higher capital investment trips with a lot of pre-commitment, I'm not sure that has come back. But the biggest COVID problem is not in this country where, at the moment I see it as a minor macro issue, but just in China. So China still has a zero COVID policy. This seems to me a big mistake. But I know that 6 months ago, I was hearing, well, after the Party Congress in the fall, they're going to get rid of that. And the Chinese economy will bounce back because they'll get rid of it. China has bounced back so many times before. Now, when I speak to the sources I have, not one of them tells me China's going to get rid of zero COVID. They give me a lot of reasons why China's going to keep zero COVID. I'm not an expert on predicting Chinese politics, but it does seem there's a very marked shift in what experts are predicting. So one could very plausibly be more bearish on China. And you look at Chinese currency moves, real estate market, it does seem that things are going worse for China than many people had expected. And the long predicted but never arriving sort of comeuppance for the weird Chinese growth model where there's so much capital investment, so much infrastructure, so much excess capacity. Maybe that's coming now in some form with, zero COVID policy as the trigger. There's just not enough expenditure flow to keep everything going that they had invested in. So again, you can interpret this different ways, but it just seems to be a higher risk. And it's coming together with the other higher risks on the table. Now here's a graph I took from Alex. He put this up on Marginal Revolution. What are the risks of Ukraine getting significantly worse? For instance, Putin deploying a tactical nuclear weapon. I really don't even like thinking about or bringing up this topic, but at current margins, I don't think we can quite ignore it. So there are various prediction forums. I don't know how good they are. The people on them are self-selected. It's like what all the nerds think. You can go to some of these forums and they'll tell you there's a 40% chance that Skynet goes live by 2070. And I don't necessarily think that and so on. But look, the best prediction forums we have give us a 13% chance of a nuclear weapon actually being used before 2024, like used in combat in some manner. I don't know how good that number is, but I would just say the mere fact that there is such a number is a bad sign in terms of the market's perceived risk premium. I was at one of these DC parties last evening, like people think if you live here, you go to all the time, but in fact, you hardly ever go to. But there were a number of national security experts there. Different people asked various questions. I can't tell you what people said, but like A, there were diverse opinions. I think I can tell you that. And B, the general tenor of the remarks was more pessimistic, say, than what you would see in the media. So this just also seems to be a risk. It doesn't have to happen. I don't want to use the pun, it's a cloud hanging over our heads, but it's a cloud hanging over our heads. And it's really quite terrible that, Putin and Russia have brought us to this point. But here we are. Final point I would make, this I guess I see as a sixth risk. I don't want to get political here, but leadership around the world. And I really don't mean any single leader. I don't want to insult anyone in particular. I think there are now some good leaders, but the overall quality of global leaders in terms of experience is lower than is usually the case. In terms of credibility, seems to be lower than is usually the case. If nothing else, like Putin is worse, and in China, Xi is worse. And that makes the world have lower quality leaders. But if very bad things happen, it seems to me in terms of like total human capital of world leaders right now, we're at somewhat of a suboptimal position. In Europe in particular, you have very weird governments coming into place in Italy and Sweden. UK, it seems to me, a very weak government. Maybe I like it more than some people in the room. But I had someone telling me today it might collapse in a week. So, what kind of position are they in to manage difficult foreign policy decisions? Macron is more stable. German leadership is quite new, does not obviously command a high degree of trust amongst the German people. So it's just not the portfolio you would like to have if major crises come. And again, I mean this apart from any particular political views you might have of these leaders. So in terms of the global economy, I am worried, like even money bet is still, that will muddle through. That's pretty much always the better even money bet. But risk premia are rising. Volatility is up. Many weird things are happening. And every morning I wake up and I look at Bloomberg.com before my usual habit of NewYorkTimes.com. And we will see.